Call ratio back spread. This strategy is where you sell one at the money call, and taking the premium collected from the call you're selling, you buy two or more out of the money calls. You use a trade like this when you expect the market to make a substantial up move after a period of stagnation. The objective is to put this trade on as a credit or very free trade or very, very cheap. If the trade is done as a credit, the profit is limited on the downside to the premium collected. The profit on the upside is unlimited. The risk on a trade like this is limited to the difference between the short and long option plus or minus the net premium. If the market expires below the short call, your risk is limited to any premium paid for the spread. At expiration, maximum loss is realized if the market is trading at the long call strike price or lower. In other words, between the short and long calls. Your maximum loss, though, is at the long call strike price. Being partially right is when the worst case scenario is realized. In this strategy, you want to be either very, very right or very, very wrong. Now, in a strategy like this, you can see where we're selling a 470 call, collecting the premium, buying two 490 calls. Now, the risk calculation in this gets a little bit, well, a little bit tough, okay, because you have several different degrees of risk. If the market is below at 470 or below, well, let's get filled first. Okay, we get filled at $120 credit. So in other words, you have several different levels of break even. Let's take it from the bottom and work our way higher. Anything, if the market is at 470 or below, this trade will be profitable by $120. If the market is between 470 and 490, this is where your real risk zone is. Now, this risk is limited to $2,000 with the market trading at exactly at 490. If the market's at 475, let's say, you'll lose $500. Okay, now that's the maximum amount of risk on the trade is the distance between 470 and 490. As the market goes above 490, the extra long option, the extra 490 call, will start offsetting the amount of money made on or lost on the 470 call. So that gives you an actual break even of 510. So you have an intrinsic break even on the trade of 510. In other words, that's where the market needs to be for this trade to start generating a profit. Why 510? Well, from 470 to 490, the 470 call will lose $2,000. As the market goes higher, that loss will be offset by the gains made on the second 490 call. Again, this is the type of trade you want to use when you have a strong conviction that the market's going to go higher. Here's how the trade works. 28 days later, the market does shoot higher. And as you can see, your $120 credit is now worth $1,620. However, if the market, like if we roll this back a little and we get to here, now in this case, the intrinsic losses on the 470 call are being offset by the extrinsic gains on the 490. If the market had gone sideways, or like if you look in this example now, as the market comes back down, about a month after getting into the trade, well, you've given back a lot of your gains. 28 days later, well, you can see how the trade maxes out, and it has unlimited profit potential.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and training techniques by industry leaders. This should not be considered as a solicitation to buy, sell, or invest in securities, options, futures, or Forex. Remember, trading does involve the risk of loss. Past performance is not indicative of future results. Stocks, futures, options, and Forex trading is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.